You swipe your card, check your balance, make a payment on your mortgage. Ordinary moments inside a hidden system built to profit from every one of them. When your bank approved that $300,000 loan, the money did not come from a vault. They created it with a keystroke. Over 30 years, you will pay back over $500,000 for money that never existed. That is only where this begins. A bank's ledger is not a dusty book or a digital afterthought. It's the engine room, the place where new money is born. When a borrower signs for a loan, the bank's double-entry bookkeeping springs to life. On one side, the ledger records a new asset, the promise of repayment with interest. On the other, it creates a matching liability, a deposit in the borrower's account. No cash moves from a vault. No pile of bills changes hands. The deposit did not exist until the loan was approved. The act of lending creates new purchasing power out of nothing, but the bank's willingness to record both sides of the deal. This is the hidden symmetry at the heart of banking. The loan is the bank's asset. The deposit is its promise to the customer. As the borrower spends the funds, the deposit flows through the economy, becoming someone else's bank balance, and the cycle continues. But the story does not end there. When the loan is repaid, the process reverses. The principal vanishes from both sides of the ledger. Money is destroyed as quietly as it was created. If the borrower defaults, the bank's asset evaporates, but the deposit remains, eating into the bank's capital. Every entry, every repayment, every default, all of it is written into the ledger, shaping the money that moves through our lives. Every loan on a bank's books is more than just a promise to be repaid. It is a stream of earnings, measured down to the decimal. The engine that powers this is the net interest margin, NIM. It is the spread between what the bank pays depositors and what it charges borrowers. If a bank pays 1% on savings and charges 5% on mortgages, that 4 percentage point gap is where profit lives. On a $300,000 mortgage at 4%, the bank will collect over $215,000 in interest alone by the time it is repaid. But in a world where rates can swing and competitors fight for every dollar, that margin gets squeezed. So banks look elsewhere. Fees, small, relentless, and often invisible, flow in from every corner. Overdraft charges, monthly account maintenance, ATM surcharges, and wire transfer fees pile up, creating a second profit channel that does not depend on interest rates. In the US, overdraft fees alone brought in over $15 billion for banks in 2019. Foreign exchange fees on international transfers add another layer, each transaction shaving off a fraction for the house. For the largest banks, non-interest income can make up 40% or more of total revenue. Every day, the ledger tallies these streams, the spread between funding cost and lending rate, the steady drip of service charges, the cut from every wire and currency exchange. All of it is engineered to extract value from the flow of money itself. This is the FE machine at the heart of modern banking, silent, systematic, and always running. A different engine hums beneath the surface of modern banking, one that doesn't wait decades for interest to trickle in. Here, profit is captured at the moment a loan is born, then multiplied as risk is shipped off to someone else. This is the originate-to-distribute model, the backbone of the securitization boom. In this world, a mortgage is not just a promise to pay, it is a raw material. Thousands are bundled together, sliced into tranches, and sold to investors hungry for yield. Each step carves out a fee, origination, structuring, placement, and long-term servicing. For a $1 billion mortgage pool, banks and arrangers can pocket $15 to $25 million before the first payment is ever made. The rest is passed on, risk and all, to pension funds, hedge funds, or anyone willing to hold the paper. The 2008 financial crisis exposed the dangers of this machine. When the value of mortgage-backed securities collapsed, overnight repo funding vanished. Haircuts on AAA-rated bonds jumped from 2% to 20% in a matter of days, freezing $700 billion in daily funding. The entire system seized, and the Fed was forced to inject hundreds of billions of dollars just to keep the lights on. Now, the logic of speed and scale has migrated to new territory. Fintech lenders and buy now, pay later firms use algorithms to approve loans in seconds, drawing on thousands of data points, bank records, purchase histories, even social signals. Approval rates soar above 80%. The model is frictionless, fee-rich, and indifferent to geography or tradition. The risk, once again, is often moved off the balance sheet or sliced up for investors. For the coders writing these algorithms, profit is measured in milliseconds. For the system, it means risk can travel faster and further than ever before. Beneath the surface of every bank account, a different kind of money circulates. These are reserves, electronic entries held at the central bank, invisible to customers but essential to the system's wiring. When one person transfers money to another at a different bank, it's not just a digital note passing between ledgers. Behind the scenes, reserves move from one bank's account at the Federal Reserve to another's, settling the transaction. These reserves are not the same as customer deposits. Deposits are promises from banks to their customers. Reserves are the bank's own currency, used only among themselves and the central bank. In September 2019, the system's hidden plumbing was put to the test. As corporate tax payments and a flood of new Treasury debt drained cash from the system, banks and dealers suddenly found themselves short of reserves. Overnight, the cost of borrowing in the repo market, the backbone of short-term funding, exploded. Rates, usually anchored near 2%, shot up past 10% in a matter of hours. For a brief window, the lifeblood of the financial system was in short supply, and banks hesitated to lend reserves, even to each other. The Federal Reserve stepped in, injecting $75 billion in overnight loans to keep the gears turning. Over the following days, hundreds of billions more were offered, as the central bank became the lender of last resort to its own banks. The episode revealed just how fragile the system's plumbing had become. When reserves are scarce, even for a single night, the entire machinery of modern finance can seize up, reminding everyone that what lies beneath the ordinary flow of payments is a tightly wound circuit, one that depends on constant, careful management to avoid breakdown. Silicon Valley Bank was built on a simple formula. Take billions in short-term deposits from tech startups and park them in long-term government bonds. On paper, the risk looked minimal. Treasury securities and mortgage-backed securities considered safe made up more than $180 billion of Silicon Valley Bank's assets at the end of 2022. But as the Federal Reserve pushed interest rates from near zero to over 4.5% in a single year, the value of those bonds plunged. By December, Silicon Valley Bank's unrealized losses on its securities had swelled past $15 billion, hidden in plain sight on the balance sheet. Almost all of Silicon Valley Bank's deposits, over $165 billion, were uninsured, clustered in a tight circle of tech firms and venture capital funds. When whispers of trouble spread, panic moved at the speed of a group text. On March 9, 2023, Silicon Valley Bank announced it had sold $21 billion in bonds at a loss of $1.8 billion and needed to raise emergency cash. Within 48 hours, $42 billion vanished from the bank's accounts, one of the fastest runs in U.S. history. Silicon Valley Bank's assets were locked up in bonds that could not be sold without massive losses. The bank had no way to meet the tidal wave of withdrawal requests. Regulators shut the doors before the week was out. The FDIC and the Federal Reserve stepped in, guaranteeing every deposit and launching a new backstop. Banks could now borrow against their securities at full value, no matter the market price. But the damage was done. Silicon Valley Bank's collapse showed how quickly a mismatch between short-term funding and long-term risk can tear through a modern bank, exposing the fragility behind the numbers. A cafe owner unlocks the doors before dawn, checking the books for the third time that week. Last year's variable rate loan payment has jumped by nearly a third. The prime rate, once a background number, climbed 5.25 percentage points between 2022 and 2023, and the increase lands straight on the monthly bill. There is no negotiation, just a new withdrawal, higher than the last, eating into already thin margins. For small businesses like this, the rate pass-through is not abstract. It is a line on the bank statement, a cut into payroll, a decision to hold off on repairs. The cafe's survival now hinges on factors set far beyond its walls. Across town, a single parent checks her balance after paying rent. The account dips below zero for a single day, triggering a $35 overdraft fee. Then a utility payment posts and another fee hits. By the end of the month, the cycle has repeated 10 times. For low-balance customers, the average annual cost of overdraft charges reaches $350, a sum that quietly rivals what some pay in interest on short-term loans. For those already living close to the edge, these fees compound, turning minor missteps into mounting debt. Payday lenders fill the gap, offering quick cash at annual percentage rates that can soar above 300%. The system is designed to stabilize bank profits, but the cost is unevenly spread. While the prime rate moves with a press release, the burden lands on small business owners and families, one payment, one fee, one missed paycheck at a time. Every day, banks generate billions from money created out of thin air, fueling cycles of profit and debt that shape our lives. As interest charges outpace wage growth, the system's grip only tightens. The question isn't who profits, but how long we'll accept the rules as they stand. Share your thoughts below.